So what is a moving average? A moving average takes a set of closed prices, adds them together and divides by that number. So 20 candles, 50 candles, 200 candles. Add that number of candles closes together and divide by that number. You get one number. You plot it on a chart, then you move one candle forward and do it again. That produces a smooth line that follows price. As new candles form, the line moves forward, dropping the oldest candle off the end, calculating it again by adding the new one. That's why it's called a moving average. There are mainly three types of moving averages: SMA, EMA, and WMA. The simple moving average is what I just described before. You want an SMA 20, you take the last 20 closes, you add the closes together and you divide by 20. That's it. Simple. The exponential moving average, or EMA, this one gives more weight, more influence to recent candles as opposed to older candles. Yesterday's close matters more than last week's matters more than last month's. It does this with a smoothing multiplier. The multiplier is 2 divided by the period plus 1. The shorter the period, the bigger the multiplier, and the faster the line reacts to price. That number is applied to the more recent candle to give it more pull on the line than the older ones. The result is a line that reacts much faster when price starts moving, because recent candles are dragging it harder than the older ones. WMA, or weighted moving averages, similar idea to EMA, but uses a straight linear weighting. If you have 10 candles, the most recent candle gets a weighting of 10. The one before it gets 9, then 8, then 7, then 6, then 5, 4, 3, 2, 1. Multiply each close by its weight, add them all up, and divide by the sum of the weights. Here, 5, 4, 3, 2, 1 adds up to 15. If it was a 5 WMA, the most recent candles always has the strongest pull on the line. But remember, SMAs lag the most because old prices carry the same weight as the newer prices. WMA lags the least because recent prices dominate and EMA is in between them. But here is what the gurus never mention. They all lag. Every single one of them. Because they are all calculated on past prices. You cannot average the future. The lag is not a flaw you can fix by choosing a different type. It is baked into the maths permanently. I placed an EMA 50 on this chart, and some would be saying, look how much it's bouncing. Look, it's bouncing. It works. You're talking rubbish, Andy. But was it really hooky? Was it really bouncing? Was it? Let's move to a 9 EMA. Look how much it's hugging now. Every bounce is working. Incredible support, right? No, the line just got closer to the price. And that is all that happened. Now let's go to an EMA 200. And now retail screams at me even louder. See, dramatic bounces. It must be institutional support. But is it though? Is it? The line did not cause any of those bounces. A great takeaway would be the line is reacting to price. Price is not reacting to the line. Change the number and you change where it bounces. That is not support and resistance. That is a line following the price around and getting credit for what the price was already doing. But there's more. Which EMA 50? 15 minute? 1 hour? 4 hour? 1 day? They're all very different lines, sitting at completely different places on the same chart at the same time. And that's before we even ask, should it be an SMA, an EMA, or a WMA? So what they do is they pick the one that fits the bounds after the event, and it always looks like it worked. Hindsight is a wonderful thing, but that is not analysis. That is finding the answer you want, then moving backwards until it fits. Now let's add some more context here. Order blocks. You knew that was coming. Look at that. Let's look at the line that failed here. Went straight through that EMA 50. Straight through it. Where did it go? To true institutional levels. It bounced right into that order block and back up. It needed more liquidity. It cared not a jot about your EMA 50. Now let's put on fair value gaps. This wasn't bouncing off an EMA 50. It was bouncing off a mitigated, bearish fair value gap, which is known as an IFVG, in the same way order blocks can become breaker blocks once mitigated. Put it all together and look what happened once the institutions had got all the way up to the liquidity they were after as we're in a downtrend and then took us down. It just blasts through your EMA 50 like it doesn't exist. And down it goes. Moving averages are not useless. They are genuinely useful for one thing, understanding the direction at a glance of recent price movement, but they are not support, they are not resistance, and they're not predictive. They are a smoothed summary of what has already happened, delayed by definition, unable to tell you where price will stop because they have no mechanism to cause price to stop at anything. The bounces you do see are caused by collective retail behavior and institutional order flow, not by a line on a chart. And when institutions want that liquidity that behavior creates, they take it every time, and retail traders get stopped out. Pulse flow does use exponentially weighted moving averages, but not as support and resistance. I use it to measure how closely a coin is correlated to Bitcoin. The EMA tracks that correlation. I mix that with another algorithm to say, is this coin going its own way and ignoring the Bitcoin price? Pulse flow also uses, as I mentioned in many videos, the EMA 50 and the EMA 200 locked to the 4-hour chart. But again, not as an entry. Purely as, are we in an uptrend or a downtrend? Should we be looking to go long or go short if we're going to trade with a higher time frame trends? Nothing more. Same family of mathematics, completely different, but the correct application. A moving average pretending to be a support level. That's what gets you wiped out. So moving averages, although they look nice on a chart, they're fundamentally the wrong tool for what retail is using them for. They tell you where price has been, not where it's going. Not where it will stop, and certainly not what institutions are doing. Okay, if that's changed your view of SMAs, EMAs, EWMAs, please would you subscribe, like, and share. You can watch one of my other videos down here, and I'll catch you in the next one. Bye bye.